Welcome to this explainer. Today, we're unpacking a topic that usually causes a ton of anxiety, but honestly, it really shouldn't. We're talking about economic downturns. We're going to look at how to stop fearing these events and start seeing them for what they actually are. Predictable, cyclical opportunities to not just protect, but literally build your wealth. Because history shows us that while recessions are inevitable, financial ruin definitely is not. So here is our game plan for navigating the economic storm today. We'll cover 4 main steps. First, spotting the storm. Second, preparing your finances. Third, defensive investing strategies. And finally, finding massive business opportunities in a crisis. Alright, let's jump right into step 1, spotting the storm, and why we really need to look past the evening news. You see, waiting for the official news to announce a recession is, frankly, a terrible strategy. By definition, a recession is 2 consecutive quarters of negative GDP growth. But here's the catch. This is a lagging indicator. By the time some official finally steps up to the mic to declare we're in a recession, the economy has already been shrinking for at least 6 months. It's kind of like relying on a weather app that only tells you it's raining after you are already soaking wet. If you wait for the official announcement to prepare, you've completely missed your window. So to spot the storm early, we have to look at the yield curve. Think of it like lending money. If you lend someone cash for just a month, your risk is pretty low, right? So you expect a lower interest rate. But if you lend it out for 10 years, the risk goes way up. So you naturally demand higher interest. Well, the US government borrows money the exact same way through bonds or treasuries. Under normal circumstances, the system rewards you with higher interest for taking on the higher risk of a long-term loan. Makes sense? But what happens when things go wrong? When investors lose confidence in the near-term economy, they panic. They pile their money into long-term bonds because, well, it just feels safer. This massive shift actually causes the curve to invert, meaning short-term bonds start yielding more than long-term ones. And get this. Over the last 50 years, every single time this curve has inverted, the economy has paid the price. But here's the absolute most critical part. When the curve shifts back to normal after an inversion, history shows that's actually the most dangerous moment. Why? Because banks have tightened their lending, businesses are pulling back, and that shift tells us the economic damage the inversion warned us about is now actively hitting the real economy. Okay, our second signal is consumer confidence. Historically, the average for this index sits around 84. During the peak of the 2000.com bubble, it was flying high at 112. During the catastrophic 2008 financial crisis, it plummeted down to 55. But look at where we are today. It has hit 47.6. That is literally the lowest reading in the entire history of this measurement. No way around it. This is absolutely crucial. Consumer spending drives roughly 70% of the entire American economy. So when people feel this insecure, they stop spending, businesses lose revenue, and boom, the layoffs begin. The third signal we track is the manufacturing PMI, which measures factory activity. Right now, it's sitting at 52. Now technically, anything above 50 indicates slight growth, which might sound like great news, but we got to look deeper. This slight bump might not be true economic growth at all. Honestly, companies could simply be stockpiling inventory right now because they're terrified of supply chain disruptions from global tensions. So put it all together, an inverted yield curve shifting back, rock-bottom consumer confidence, and shaky factory data. The storm is definitely visible. Which brings us to section 2, preparing your finances and building your financial fortress. Look, an average recession only lasts about 10 months, but the financial devastation that can take years to recover from. To build an unshakable financial fortress before the storm hits, you need to execute 4 essential steps. First, increase your cash flow. Add multiple income streams, like a side hustle or monetizing a skill you already have so you aren't completely dependent on a single paycheck. Second, build a rock-solid emergency fund. Third, hedge against the inevitable inflation that follows government money printing. And fourth, learn recession-proof skills. You want to make yourself so indispensable that you have job security and negotiating leverage no matter what the market is doing. Let's zero in on that emergency fund for a second. The standard old-school advice of saving up a 3-month emergency fund, it is completely outdated for a recession. When a downturn hits, hiring freezes happen everywhere. And let's be real, job hunting can drag on forever. You actually need 6 to 9 months of fixed costs saved up. And this is a massive point. This money must be in cash, not stocks, cash. If the stock market drops 40% the exact same month you need cash to pay your rent, you're going to be forced to sell your assets at a massive loss. And that brings us to step 3, hedging against inflation. When crises hit, governments inevitably start printing money, which causes inflation and rapidly eats away at your purchasing power. You want to hold hard assets, but you have to pick the right ones. Stick to time-tested assets like gold. It operates strictly as a wealth preserver and has successfully held its value for over 50 years. On the flip side, stay away from industrial precious metals like silver or platinum during a recession. They rely heavily on industrial use, so when factory production stalls out during an economic downturn, their prices actually tend to drop. Moving right along to Section 3, Defensive Investing Strategies. Or as I like to call it, harvesting the rain. So recessions always follow a pretty predictable script. Mass panic leads to a widespread sell-off. But that exact panic, it creates generational entry points for buyers. While the generic everyday advice is to freak out and sell, the smart money calmly flows into specific defensive asset classes. We're talking about dividend stocks, sector ETFs, real estate, and farmland. And what do all of these have in common? They hold their ground. They provide basic human necessities. Things people are literally forced to buy, regardless of how bad the broader economy is doing. And the historical data proves exactly why we look for these opportunities. Market crashes are temporary cycles. They are not the end of the world. Back in 2009, the market crashed 57%. But investors who bought at the absolute bottom saw a 134% climb over the next 5 years. Same thing during the 2020 pandemic. The market dropped 34% in a flash, but fully recovered in just 11 months. The market heavily rewards people who have the discipline to keep buying while everyone else is selling out of sheer fear. Let's look a little closer at real estate. A lot of people just assume real estate crashes during a recession. But honestly, that's a bias left over from the 2008 crisis, which, remember, actually originated in the housing market. Unless the crisis is specifically housing-based, real estate is incredibly resilient. Prices can stay flat or even rise, just like they did in 2020. And hey, even if property values do temporarily dip, the asset continuously generates monthly rental income. Because at the end of the day, people always need a place to sleep. Farmland is another rock-solid defensive asset. Just look at its trajectory. The values have risen almost entirely uninterrupted from $750 an acre back in 1950 to $4,350 today. The absolute beauty of farmland is that its value does not move in lockstep with the crazy volatility of the stock market. It is grounded in one undeniable basic truth. The global population is growing and the world is always going to need to eat. And finally, Section 4, Innovation in Crisis, and finding those massive business opportunities. You know, a recession doesn't just destroy businesses. It really serves as a massive reset button for the whole economy. And here's the secret. Core human needs stay exactly the same. People still need to eat, they still need clothes, and they still want entertainment. What changes is how they choose to meet those needs. Someone who ate out 3 times a week pre-recession might start cooking at home. Someone who bought expensive designer clothes might start shopping secondhand. The old system stopped working, and whoever steps in to find a cheaper, simpler, or more accessible way to deliver that same result, they capture all that shifting demand. The ultimate proof of this principle in action is Groupon. They launched their company directly into the teeth of the catastrophic 2008 financial crisis. Think about it. On one side, you had consumers desperately looking for cheap deals. On the other side, local shops and restaurants were terrified, sitting in half-empty venues. Groupon just built a bridge between them. They solved massive problems for both sides simultaneously. And by providing that cheaper, simpler solution, they hit a staggering $1 billion valuation in just 2 years. Unbelievable, right? So, as we wrap up this explainer, I want to leave you with a question to spark your own crisis innovation. Look around at the shifting economic landscape today and ask yourself, what cheaper, simpler solution can you provide to a market that is actively changing its habits right now? What can you build that actually thrives when the old system stops working? Recessions are simply a test of preparation and perception. So, build your fortress, look for the